Hello and welcome to BloombergQuint. Now, the monetary policy decision sort of got washed away in the decision of the RBI to announce a one-time restructuring scheme this week. But there are important clues to take away from what the RBI did not do, what the MPC did not do, and what they said. Joining us to make sense of all of that is Kaushik, Chief India Economist at Deutsche Bank. Kaushik, thanks so much for taking the time to be with us. It's great to have you here. Let me first ask you, Kaushik, on the headline decision. I know that you were in the camp that was expecting a cut in rates. What do you think swung the decision, and do you see it as perhaps not the ideal situation?
Hi, Ira. Thanks for having me on your show. These are all very subjective decisions when you take a call whether to, reduce interest rates or not. And you know for a fact that rates need to come down. So whether it's August or October, it's just a judgmental call. Now, obviously, as the MPC has pointed out, they have a lot of uncertainty about the inflation outlook going forward, and that has been created, because of this April-May number that has come out from the statistics office, which has come on the higher side. In my view, this number has a lot of issues related to statistical imputation. Also, you have to consider the fact that gold inflation has gone up quite a bit between March and July, and every month it is increasing, 44% YOY. So you have to strip that impact of gold inflation out. You have to strip the impact of fuel price impact out, and then if you try to calculate core inflation, it could be actually below 4% that compared to the headline 5% that it is reflecting at this point of time. Nevertheless, I think RBI has a mandate of headline inflation and it is above 6%. So the MPC was not very comfortable about cutting rates at this point of time. Although if you've seen, MPC has mentioned that the second half of the fiscal year, they expect inflation to be moderating. And my take was that if you are a central bank and if you're doing monetary policy, you have to be forward-looking in nature, not backward-looking or looking at current inflation numbers. So if you feel that inflation will come down in the next 6 months or 9 months, then you should act preemptively because it takes a bit of time for transmission to happen. And that's why my expectation was that there could be a rate cut, in this policy itself, because RBI would be forward-looking. Now, even if the rate cut did not happen or was not supposed to happen, the expectation was that RBI will give some form of indirect easing, and that could be through different channels. Like, for example, they could have just cut the reverse repo rate, not touching the repo rate, which is the mandate of the MPC, or they could have increased the HTM limit for bonds. That could have helped the term premium to compress, or they could have bring something like a standing deposit facility below the reverse repo rate. So there were multiple ways that RBI could have signaled an implicit easing, even if they did not cut the repo rate, which did not come, and therefore the term premium still remains high. And that's a bit of concern, which we can discuss as we move forward. So that's why the market was a bit disappointed from the financial markets point of view of RBI not providing any kind of implicit easing signal. And the guidance, if you see, they're saying that, governor is saying that they will consider cutting rates only when they get a sense of inflation coming down on a durable basis, which means that inflation, the rate cut could get delayed to as late as December. So that's the little bit of disappointment for markets from this point of view.
All right, a couple of questions, and I'll dive into the inflation part first, Kaushik. So one thing which you also point out in your note, and I think it must be sort of reiterated, is that it's surprising that the MPC even this time around has stayed away from a growth forecast and, more importantly, an inflation forecast. I think commentators have pointed out in the last few months that in an inflation targeting regime, the inflation forecast is the sort of intermediate target. So in the absence of an inflation forecast from the MPC, it's a little difficult to judge what they are working with.
Absolutely. If you think about it, I mean, both growth and inflation, I mean, by now I would have expected some kind of growth forecast to come out. I can understand March and May, when the last 2 times the governor had cut interest rates, it was not clear. But by now, if there was at least some kind of indication with a even uncertainty band, that would have helped to understand how much contraction RBI is building in. There is one indirect way to understand. If you see in the financial stability report that RBI presented a few weeks back, they have taken for the stress testing exercise the baseline growth contraction at minus 4.4%. So that is one way indirectly to kind of feel that RBI probably is working with a minus 4.5% contraction, which is also the forecast that IMF has given, which is more or less in line. But our take is that growth would be much more negative than minus 4.5%, because IMF gave it a few months back, and probably that could get revised downwards even more with the localized lockdown. So some bit of forecast from RBI would have helped. They could have said that this has a big uncertainty band. But the bigger surprise, as you mentioned, is that we have the April-June inflation number now. We know that it is not very reliable, but at least we have some number based on which the private sector economists had given some forecasts, and we were expecting that RBI would give some bit of quarterly forecast range, so that we could at least make out that what is the level of uncertainty that is there around it, inflation as far as RBI is concerned, and when should we think of RBI kind of coming with the next rate cut or any action, or whether there is a chance of further rate cuts or the rate cut cycle is over. So unless I know what RBI is working with, ultimately my job is to predict what RBI will do. I can keep on saying what RBI should do, but in order to know what RBI will do, some bit of forecast would have definitely helped.
100%. On the inflation, the language around inflation, what did you take away from it? Are they actually talking about material supply side issues on headline inflation? And if so, what are those based on? Are they mostly based on food? And then, like you said, it was an imputed number. Or are they seeing something that we are not seeing in public domain yet, which they are a little bit worried about? They mentioned one, which was the excise duty hikes.
See, the problem with this inflation targeting is that you're putting too much emphasis on one single nominal, anchor, and you're not kind of, taking into factor all these other factors. Like, for example, I can talk about core WPI inflation, which is non-food manufactured goods inflation being negative, which is almost, which is signaling that the manufacturing sector obviously is in a recession. And you can look at that number and take a call what you need to provide support, not just for the service sector, but for the manufacturing sector. So just looking at headline CPI, which is loaded with food basket of 46%, then you have fuel items over which RBI doesn't have any control. Then you have all these administered price items in fuel, apart from petrol and diesel. And we know that in June, petrol prices and diesel prices were increased quite significantly. So if RBI doesn't have control over these things, and it's not like these items will lead to a generalized increase in prices, which is what we fear about from an inflationary point of view. And if you've seen RBI's guidance, they're also expecting inflation to come down in the next 6 months. So you have to take these nuances into consideration and not just base your judgment on the headline inflation. But unfortunately, that is the mandate for the MPC at this point of time. So if they have to be honest with the mandate, they have no other option but to stick to a conservative kind of guidance that they have provided. My calculation seems to suggest that core inflation, which was about 5% in June, actually is about 3.5%. If you take out transport inflation, if you take out gold inflation itself is contributing 70 basis points, 80 basis points to inflation every month. Then you have transport inflation, which has gone up in June. Now, are these things which are going to impact inflation in a big way where demand remains so weak? And you just have to see the evidence of the past. Whenever we have seen a growth slowdown, in whichever period you take, with a lag, core inflation has already come down. So if the April-May numbers were not so high for core inflation, the base has already gone up, then you wouldn't have got June inflation also so high. And therefore, now we are kind of working with these numbers because we don't have any other way. But I think this just delays the process of support that the economy needs because of following this inflation targeting mandate.
Kaushik, just a question slightly longer term. I know going into the policy, I saw a note of yours where you'd used, a Taylor rule framework to say that perhaps 3.7 odd % is where rates will settle. That plus other structural issues, such as the fact, as Gautam Bhattacharya of Axis Bank had pointed out to us yesterday, that we are a financial sector driven by deposits. We do need capital inflows over a longer period of time, so some interest rate differential has to be maintained. Would you say that somewhere close to this 4 odd % is pretty much effective zero lower bound for us?
Yeah, so I'm not saying that RBI has a lot of room to cut rates. I mean, I'm seeing another 25 basis points at most. Now the question is whether you should have delivered it now when the economy needs the most, or do you want to, push it till October, December? That's a judgmental call. Now you have to, okay, when you talk about interest rate differentials, today the US 10-year treasury, the way we measure it is we take the India 10-year GSEC, yield, and you take the US 10-year treasury. Now the US 10-year is at 50 basis points or 60 basis points. And our interest rates are close to say 575 on the new 10-year bond. So your interest differential is still above 5%, which is quite significant to attract capital flows. It's not that debt inflows are not coming in because of interest differential being lower, because the US interest rates have also gone down significantly. There are other factors why it is not coming. First, it was the rating, related uncertainty. First, in March, it was the global risk aversion when you'd expect money to flow out of fear. That was there anyway. And then there was the fear of ratings downgrade and all these other issues. The other big reason why money is not coming in, because the debt market participants expect RBI to participate and buy bonds to to take care of the demand supply mismatch. And unless RBI comes in, people are not sure whether they should participate in the market, because yields will have a natural tendency to go up when the rate cut cycle is coming to an end. So that's why probably the offshore investors are staying on the sidelines or choosing other countries where they have a bigger opportunity. Now, the bigger point to think of it is that we are having this crisis, which is a crisis of a lifetime. So you cannot say that interest rates are low in the last 10 years when your growth is going to be lowest in the last 100 years, maybe. So today, if you compare today's interest rates with what in 2008 was, now 2008, the growth number that we got was much higher, right? Compare even with the slowdown, we got a very strong number relative to what we are going to get now. We are talking about a 15 to 20% contraction in one quarter. And for the year as a whole, we are talking about 6 to 8% contraction. When was the last time India saw 8% or 7% contraction in real GDP growth? So you have to compare the interest rates, what we have today, with the kind of growth, that slowdown that we are going to see. And your other commentators must have highlighted to you this, that we should not look at year-on-year growth rate recovery next year. We should look at the levels of GDP. And from December 2019, where India was, which was also a very weak setting for India, it will take at least 2 years for India to come back to those levels. So just imagine if you have minus 7% growth this year and plus 7% next year, you have just 0% growth for 2 years, whereas you would have got a 10% growth in 2 years, this year and next year. So you've lost almost 10-11% of output permanently. And that is a damage which will be there for India to deal with for a long period of time. So you have to think of interest rates lower bound from that perspective. And that's why we think even if the rate cut cycle is over or close to being over, RBI has to be proactive in managing interest, managing bond deals or the longer end bond deals to ensure that yields do not start moving up and they remain low for a long period of time.
Understood. Thanks for that analysis. On liquidity side, Kaushik, so like you said, no announcements either on an OMO calendar, which frankly, I don't think they can do given the kind of FX flows that have been coming in and the liquidity that exists, but nothing on the HTM side. Maybe they are waiting on that for the second half of the year when potentially, government will be borrowing, corporates may start borrowing a little bit more. So they're preempting that they will need to step in, post September, October, and hence holding off on their fire.
So, this is what I'm hearing in the markets, that, that at 575, 580, both government and RBI are happy that yields are, at a decade low. So we don't need to care. But one thing you need to remember, that nominal GDP growth is contracting at a very fast pace this year. And your nominal interest rate is significantly higher compared to that, even if it has come to a low in the last 10 years. So your debt GDP dynamic, which works based on real interest rate or real GDP growth, or you take nominal interest rate and nominal GDP growth. So nominal interest rate is higher than nominal GDP growth by several percentage points. So your debt GDP will have a tendency to move up if this dynamic becomes negative. So that's why you need to reduce the longer term rates as much as possible so that your debt GDP also doesn't go up. So that is also one thing you need to keep in mind. Now, the thing is, we know for a fact that there is no other way but RBI will have to buy bonds. Why is that? Because banks cannot do everything. You cannot ask banks to both lend and buy bonds. At the end of the day, you're going to get a certain amount of deposits and banks have to choose what they want to do. So if the banks are pushed to lend, which is what is required for, growth to kind of get supported, because NBFCs will be deleveraging to a large extent, then they will have lesser money to buy bonds, and the banks are 40% of the outstanding bond market. So if the banks are not going to buy that much incremental supply, and the supply risks are always there, they can be increased also, then who's going to buy that incremental supply? It's not that the FIIs will, even if they come in, they will be a marginal factor in the market. And you have the LICs and you have the insurance companies will be buying their natural part, but not to the extent of the supply. So RBI will have to come in. Otherwise, what will happen is that wherever the rates are today, if there is no more rate cut or just one rate cut, which is already priced in by the market, the longer tenor bonds will have a tendency to keep on moving up. And then you would require RBI to come in. So you're right. Okay, it might maybe the case that from second half of the fiscal year, RBI comes in and starts buying bonds. And at this moment, they announce one operation twist here and there to make sure that bond yields not go up to 6%. But there is some kind of proactive kind of support that is required from RBI. And remember, this problem will not go away just in this year. Next year also, it will not be easy to reduce the fiscal deficit that significantly, and therefore the debt burden and the market borrowing will not go away anytime soon. So this will remain a longer term issue, and from that perspective, we think RBI will be coming into the market maybe in the second half of the fiscal year.
Are you building in more sort of fiscal stimulus, fiscal revival package in the second half of the year?
See, when we did our fiscal calculations, we gave a number of 8% of GDP for center's fiscal deficit. Now, how do we arrive at that number? So your target was 3.5 or 3.6, which was given. Now we have built in 2% additional, expenditure, 2% of GDP, and we have built in another 2% shortfall in revenue. So 2 plus, so this is like 4%. So 4 and 3.5 is 7.5. And just the drop in nominal GDP growth will increase fiscal deficit by another 50 basis points. So altogether, your center's deficit could go up to 8% of GDP. Now, within that 2% of additional expenditure, the on-budget additional spending that the government has announced is about 1.5%. So 1% was what Finance Minister announced, and then Prime Minister Modi announced another scheme which was close to 0.5% of GDP. So I expect another 50 basis points of GDP worth additional fiscal support that could come in on budget, which would take the fiscal deficit altogether to 8%. But there could be more schemes which could be announced, below the line, which doesn't hit the fiscal deficit per se, or which could be, done through the banks or other intermediaries, which has been the case in the last 2-3 years. But remember, all these things that you do may not add to the deficit, but is adding to the debt. So the right way to look at India's fiscal stress is to look at the debt GDP ratio, and which would be going up to 84% from about 72% in the last fiscal year.
All right. Two questions, Kaushik. One, have you been adjusting your growth forecasts along the way, given the localized lockdowns, which seem to be delaying the recovery? Do you see material downside risk to your current forecast? I think you're at about 6.7. Correct me if I'm wrong.
No, so we had a minus 6.2% forecast. We had that forecast from 29th May when the GDP numbers came out. And we had already given a worst case scenario forecast of 8% or 8.5% contraction if things kind of continue for a longer period of time on the COVID-19 getting worse. And it looks like the localized lockdowns, there's a risk that they could get broad-based, or you could see more problems coming in the next few months. So it could be possible that your GDP growth contraction could be close to 8% compared to a 6% baseline scenario. But I will look at that forecast only on 31st August when the first quarter GDP comes out. We need to see what kind of numbers come out, and by that time it will also get clear what is the future outlook for the COVID-19 as well as policy support in September, October. What are we expecting? And I will take a call at that point of time. But it looks like the growth forecast is moving more towards the negative territory, towards 8% contraction compared to 6% that we have now.
All right. My last question to you, Kaushik, is again slightly big picture. This time's meeting completed the 4-year cycle of the MPC. Two-part question. Do you give them reasonable points for having had a good first run? I know that global factors contributed to the moderate inflation scenario, but also is the market worried about any volatility? Should that change happen in the midst of a crisis like this? we don't know whether they're going to extend the term or change.
So the first point is, what this MPC structure or this inflation targeting has done is bringing a discipline into this whole thing about looking at inflation more closely and looking at CPI more closely, which matters more for the macro dynamic, not WPI. Now, the thing is that, if you think of it, they have been successful. They have kept inflation low for most of the period. It could be because of global supportive factors, or food prices were down, luckily for some period. But the problem with this inflation targeting mandate is it's full of food and fuel, which RBI doesn't have control. So in a particular period, if it were to go up, especially at this point of time, because of when growth is so low, that puts the Monetary Policy Committee in a bind, because they are legally mandated to react only on the basis of that headline inflation. So to that extent, that kind of becomes challenging, this inflation targeting mandate. So this will come up for debate, I'm sure, on in March 21 when this thing comes to an end. But overall, if I think about this MPC committee and what they have done, I think they have done a good job. The other thing what they have done is bring focus into keeping real interest rates positive. Most of the misallocation of capital that happened in India and happens across the different parts of the world is because real interest rates are too low, and you keep, you tend to give false signals to the market, and then you see a misallocation of capital. Then you see a artificial boom followed by a bust, and boom-bust cycles are pretty common in emerging market countries. So if you keep real interest rate positive, that helps to keep this excesses in check. That keeps current account deficit in check, and that helps to maintain a stability for the foreign exchange and rupee as well. But the thing is, today we are in an unprecedented crisis. We can't use the same template that was there for the last 4-5 years to use in the same crisis when we are going to have a -8%, -9% contraction. So in that sense, you need to keep the cost of capital low so that businesses can survive, so that you give some support over a period of time, and not just for this year. This has to continue. These low interest rates have to remain low for a long period of time so that the economy can get a breather and start to move towards that normal situation that was there maybe in 2017, not even 2018, because 2018 we had the IL&FS crisis and everything started moving. So it's a long and bumpy road to recovery, as I write in my report. So we'll see how it goes from here.
All right, Kaushik. Thank you so much for taking the time to speak to us in detail. That's Kaushik Das of Deutsche Bank giving us his view on the economy. Thanks so much for watching Bloomberg.
Thanks, Ira.